indicator panel, Bob is going to bring us up to speed on what's going on in DC and beyond DC, what sort of advocacy opportunities we have in making sure that the low-income housing tax credit program does well in the coming months. After we finish that piece, Mark is going to talk with us about the schedule ahead and what else is going on at Maine Housing. So when all that is done, we expect there will be a little bit of time left for additional questions. So again, I will keep monitoring the Q&A button. Why don't we get started? I can see right now we have about 125 of us on the call right now. So I'm going to start with Bill Shanahan and just ask you to kick us off here and help us understand how things are going in the investor community. I mean, 6 weeks into this crisis, what are they saying about pricing and terms and the outlook for projects that haven't already started construction? What are you seeing?
Well, good morning, everyone. And Liza and Greg, this is impressive. It really is. Congratulations. As far as the investment community is concerned, banks are telling us it's business as usual, but they've been short on details. I think they're trying to find their way a little bit, and capital markets are obviously being pummeled a little bit here. So it's really, we're getting a lot of support from folks saying that, this is a time for us to be in the market. But they've been short on details, and I suspect you'll hear the same from others. So you see, it puts us and the syndication firms in an awkward position of trying to make commitments going forward on deal terms. We don't know what they will be. Traditionally, we've got multiple platforms we invest from. I think others will talk about this too, but we traditionally have proprietary funds. We've got direct investors. They're committed. They're doing deals. We can get pricing from them because it's a one-off proposition. The multi-funds, depending on where they are in their gestation, are a little harder to judge. I mean, if you've got commitments from us and we've gone to a closing, then you can feel good about those commitments. They're there. They're solid. No one's going to backtrack on those. It's a little bit harder for those projects that are sitting there with a reservation and trying to shop and figure out where they are. And, we're hesitant as a company. We can't go out right now and tell you what we can get for pricing and deal terms. And we say this often, but it's not only the pricing, it's the deal terms. And we can get into that a little bit more. I'll just give everybody else a chance to kind of respond. So, Greg?
I'm learning. I was muted and now I'm unmuted. Michelle, what might you have to add to what Bill was laying out?
I would echo what Bill said, and also just similarly, we have two investment platforms, our proprietary funds and our multi-investor funds. I would say, our investors are really focused on getting current deals closed and looking at new deals on a case-by-case basis. The proprietary investors can issue firm commitments at their discretion, but some are taking a pause at this point. We aren't issuing firm commitments for our multi-investor funds right now, and we are providing, letters for application. But a lot of our investors need to continue to meet, or all of our investors need to continue to meet their CRA requirements. But they really need time to kind of assess their financial situations to see if they'll be in a taxable position going forward. So it's a little bit of a wait and see approach. And we're just in constant contact with our investors to kind of see how, they're progressing as we kind of move through this unknown environment and this, kind of day-to-day changes. So I'll turn it to Rob if he has anything else to add.
Thanks, Michelle. No, it's a very similar story as Bill and Michelle both laid out. But as a large national firm, we do have some other options that help. We do have GSE money. We do have large national investor money that is smart, thoughtful, and still in play. So the same story of the multi and the proprietary options. I think on the proprietary side, we have a lot of options that are in play today. It's slow, careful money though. On the multi side, Boston Financial's lucky enough and maybe good enough to have a situation where we closed our $205 million multi-fund in early March. Our warehouse line is clean. So we're able to strategically put together what we think will be a next multi-fund coming out in a few months, and very strategically and very carefully start to put that together. So we are able to get some multi-fund future deals lined up. I think in terms of terms, they are straight down the middle of the fairway. You can expect the full 6-month reserves that people generally were looking for. That kind of degraded a little bit over time. That's probably going to be there. The deals with aggressive commercial underwriting or significant amount of market underwriting with market rents being underwritten in that, those are more difficult. Sponsor quality is very, very important today. Deal liquidity, so holdbacks. It's really about strong yielding, strong structure transactions that can get done today still. The other ones are going to lag a little bit, it seems.
Thanks. Staying with you, Rob, just on the question of the investor pool and beyond just today, like looking forward months, maybe a year, just from the position you're in and understanding the market, what drives people to the market besides CRA. I'm just curious your thoughts about where you see the investor pool generally going in the future. I mean, if one can assume that we're headed towards a recession, and if one can assume that many investors are likely to not have as much profit and not have as much tax burden as they would otherwise, that doesn't feel good about where things would likely go in this scenario. And I know none of this is known. This is just kind of from your perspective as somebody who understands what motivates investors. Just curious if you could give your thoughts on where you see all this going in the longer term. Sure.
I think people should be optimistic for the future. I think that, and Bob will talk about this a little bit, there's really two investor classes. There's economic investors and there's CRA motivated investors. And as long as the CRA rules don't change dramatically, we're not going to see the majority of the banks that we all know and have closed with change dramatically. They still have their CRA motivation. I think the new normal will be some lower pricing generally. As demand wanes now, new pricing will get set, deals will still get done, and investors will likely try to hold on to that new yield hurdle. It's not a grab, it's that the yield hurdles are very low. And if it becomes a new normal, I think there's a good chance that in some markets, the pricing that will drop to maybe 2-3 pennies somewhere in there might hold for a little longer. But in the medium term future and the long term future, as long as CRA is not dramatically changed, I think you'll see the same strong market that we have right now.
Okay. And by the way, we'll get to the question of CRA a little bit later when Bob Moss is speaking. Bill, anything you wanted to add to what Rob was just talking about?
Yeah, it's right now there's so much unknown around in the market. That's what's kind of creating the chaos. And until things settle out and things are predictable, it's going to be hard for people to re-engage with us. We had a cluster of investments that were going for approvals at the investor level, and they just pulled them in the first quarter or in March. And, they just did not want to hear no. They didn't want to proceed with that investment and hear that, we can't vote on that now. And so they pull them expecting that things will settle out a little bit and things become predictable. One of the kind of things we ought to be cognizant of is a lot of us communicate with banks and we're talking to community development officers often. And, they've been our friends. They've been very supportive. They're the kind of the engine at the bank that helps us get our deals done. But in a situation like this, that discussion is going to float higher up in the bank, and it's going to start morphing into the credit areas of the bank, and it's going to morph up to the C-suites. And when CEOs and CFOs and so forth are distracted with so many other things going on in the banking industry, it's going to get harder and harder for those community development officers to get the kind of traction and attention they've normally gotten. And we need to continue to be supportive of them and make a case. Our portfolios have been bulletproof for years. This is a pretty good asset class. And right now we can continue to trade off that. We need to know where our portfolios are going to be in another month or two. But, right now we can still brag about the fact that we have a very solid track record. And we need to help our bank partners make that case going forward.
Great, thanks. And Michelle, anything you have to add? And also based on a question that came in too, and speaking to this, somebody was asking, what is a CRA investor? Maybe if you wouldn't mind just spelling out what a CRA investor is versus another kind of investor.
So CRA is Community Reinvestment Act. So these investors are motivated to invest in certain locations or certain areas across the country. Those investors will typically take lower yields for specific locations where they're driven to invest. And on the other hand, an economic investor is really looking to invest purely for the return. So typically you'll see a higher yield benchmark for an economic investor. And so, just going along with what Rob and Bill were saying, I think, we feel in the long run, the demand for affordable housing will remain strong. So we're optimistic that we'll recover from this recession or potential recession similar to how we did in 2008. I think one difference here that we didn't see in 2008 is that a lot of the investors in 2008 were out of the market completely. I think the investors here are still in the market. They're just taking a pause and trying to assess the situation. And I'd also add that, we're seeing, we just recently launched our next multi-investor fund, which is fairly full. We're expecting to close that later this year. And we just recently closed another fund, our multi-investor fund, earlier this month. But at this point, the focus is really showing our proprietary outlets, new transactions. So I think that those proprietary investors are going to start to see a lot of deals because the multi-investor platform is sort of on hold. So those investors have more kind of autonomy. They have kind of the pick of the litter because they're seeing so many deals. So that kind of goes along to really digging into the sponsor, terms, all those things are going to start to separate deals for our proprietary investors that are looking at new transactions.
Great, thank you. And Michelle, real quick before we go to the next question, question coming in from John from Portland. Whether you could speak to any differences in pricing or investor interest for deals that have both LIHTC and federal historic tax credits in them.
I personally, I haven't looked at any deals with historic credit recently, and so I don't know that has impacted any investors' pricing. I know that maybe Rob or Bill could speak to that, but we haven't really seen any difference in how that's viewed from an investor perspective at this point.
Yeah, we're looking at and doing a few deals that have both the federal LIHTC and federal historic. There's no difference, John from Portland, from what it was a few months back. It's a blended return. So it's really more of a question is, what's that new return? The fact that there's historics paired with LIHTCs does not change a deal for the better or worse. A federal historic deal is better by nature because there is some 5-year credits in there. So if you want to compare a historic deal versus a non-historic, you're probably looking at better pricing. But the fact that they're paired is no different given the current market.
Okay. And Rob, while we're with you here, someone named Gronk from Tampa Bay has a question. Whether there's any kind of different outlook for projects that involve large occupied rehabs versus new construction projects.
I don't know if Gronk thought that deeply. That's a pretty good question there. Yeah, I think there is. I think there is a difference. You know, we have to think about pricing today. We have to think about terms today. We have to think about resident safety today. And new construction projects, I think investors are more apt to jump into now rather than in-place rehabs, especially elderly in-place rehabs. And I think all owners and operators should think that way. It might behoove all of us to wait a little bit before we start going and replacing cabinets and countertops and folks. So that's not to say that's the case for everybody. Every deal is a little different. But I would feel more comfortable if you're trying to get a new construction deal closed today than an in-place rehab.
I would just add to that in terms of pricing, you know, ag rehabs historically can end up pricing better because of if they're in-place rehabs, you have the immediate credit benefit. But I think, as Rob said, you know, there are going to be more deals that everyone's looking at, and I think the preference would be to be looking at new construction deals. And I think with COVID, the deals in our current portfolio that are ag rehabs that are under construction or being rehabbed right now, it's added a level of complication with in-place rehabs, having tenants, you know, there that were expected to be going to work during the day while the work was carried out in their unit. So I think that there's just that additional complication with, you know, tenant in place rehabs from a kind of COVID perspective.
Great, thanks. I want to ask you this, Michelle. I think this might have to be our last question before we move on, although again, there are other questions coming in, and I think at the end we might be able to fit those in too. But Michelle and then Bill, real quick, any other COVID-related impacts that you think folks should be thinking about now? Construction delays, supply chain, you know, first-year credit delivery, other issues you think folks should have in mind?
Sure. So I think on the construction side of things, our investors are very interested in understanding what level of cushion has been built into construction schedules. Most of our investors are looking for 3 to 6 months of cushion. They want to make sure that there's enough construction interest carry, there's enough contingency in the budget. A lot of our investors are asking that the first 90 days of contracts are bought out and that supplies are on site because there's a concern of supply chain issues moving forward. And I think, you know, you want to make sure that you have extensions built into your construction contracts if there's delays on that front. And, you know, Rob alluded to this before, but I think just generally making sure that there's more cushion in the budget. So, you know, 6-month operating reserve minimums, larger contingencies. You know, every investor is going to start to scrutinize all of those things much more closely and carefully than I think even before.
Great. Bill, anything you want to add on that front?
Yeah, it's the same. And, you know, sponsor quality of sponsor, like Rob mentioned, is really important, you know, more important than it's ever been. You know, the audience has got to expect us to ask more questions because we're going to be asked more questions. And while we stress a deal, we're going to get asked to stress that deal even more. And questions around reserves and debt service coverage and capacity, financial capacity of sponsor. You know, we're going to have to drill down through those. And I think Rob mentioned too, proprietary investors have the luxury of being able to, you know, drive this. And if they're in as a sole investor, they're going to be asking us to drill down through deals harder and deeper than we normally do. And unfortunately, that's going to be a pass-through for us too, because we're going to need the cooperation of our general partners and developers to get the answers that we need. So I suspect you're going to see some additional asks going forward.
Okay. Thank you, and Rob and Michelle, and obviously, Bill and Michelle and Rob aren't going anywhere. They're still going to be with us as we go on to the next part of this conversation. And again, at the end, there's going to be opportunity for more questions and discussion on any of these topics. But I do want to move us to the conversation about advocacy and policy that's going on right now around these issues. And we're really grateful that Bob Moss is with us today, who's very much, as usual, in the mix and informed about what's happening in Washington and beyond. So thanks again, Bob. Could you just start us off by talking about if there's anything relevant to housing and the package that's likely to pass through Congress today, and then what you see moving forward?
Sure, Greg and Liza, thank you very much for having me on this morning. It's a happy Earth Day, the 50th anniversary of Earth Day. I wasn't born during the beginning of that, so I'll pull your leg here a little bit, but Bill Shanahan knows. We've gone through this madness of March, Greg. We've spent so much money, trillions of dollars. Senate yesterday passing a $483 billion bill, no housing provisions included. And so we have one more train leaving town, most likely the week of May 4th, when the House and Senate are scheduled to return. So housing advocates have been calling for a wide range of housing provisions. We've been talking about, of course, the 4% fixed rate for bonds and lowering the 50% test. But we're also talking about housing assistance funds and either expanded vouchers for beyond the HUD voucher system to the tune of Senator Reid has proposed $100 billion, $250 million average per state for rental housing assistance. And that could either come in the form of a voucher through the current system or through HAMP, which would be housing assistance mortgage payments to owners of multifamily properties so that they can maintain and help their lenders maintain their portfolios. So there's a lot going on right now, but the next bill is going to be a bigger bill. Whether it includes infrastructure, Greg, I don't know. We can keep waiting for infrastructure for a long time, but I think it's going to be to the tune of $1 trillion. It's going to include $500 billion for states, as the governors asked for last weekend on the Sunday shows. And I think that's the last train out of town. So we've got to get some of these provisions in this next bill when they return May 4th, because they're not going to do what they are doing this week with the House. They're going to stay away till May 4th and vote in person, hopefully and healthily, when they're all back in DC.
Great. You mentioned the 4% floor. That's something I think a lot of people are interested in. And again, we've talked about this a little bit at our in-person meetings lately, but the 4% rate is down to something like 3.06% or something like that. Yeah. Obviously, the value of the 4% credit is not nearly as high. That's relevant for our senior housing bond projects here in Maine. It's going to be very relevant for our state affordable housing tax credit projects. Could you talk a little bit about the likelihood of that being in that next train in early May, and also what that might mean in terms of what projects a 4% floor could affect?
Well, I think, first of all, the 4% fix is a united rally by all of the advocates. When you get all of the advocates for housing calling for provisions they want, you get a wide range of different asks. Yet the 4% fix has a united front on it. Senator Cantwell, as you've all known, has been outspoken in pushing this issue. We have a weekly call with her and her staff, and she believes this is the time for us to try to push this in the next couple of weeks. What it means for transactions is it means for any transaction that was not yet placed in service as of January 20th of this year, it would receive a 4% fix. So those deals that might be under construction would get additional credits. And you know, we're all united behind this. At the same time, there's many of us that believe in this housing assistance fund too, as a short-term, maybe 3 months, just a 3-month period of providing rent either through the landlord or to the landlord directly. So there's kind of those, both of those things are happening right now. Senator Schumer on the floor yesterday called for national rental housing assistance in his remarks, in his speech. So it's gaining some momentum.
Great. It's also really helpful, I think, for folks to hear what you were just saying about the fact that that floor would attach to projects that were not placed in service as of January 1st, 2020. It's a pretty big deal given how much that percentage has fallen. I want to ask you about two other issues that I think folks are thinking about right now. One is the issue of deadlines in the LIHTC program. You know, folks who are supposed to reach certain benchmarks in their projects, like placed in service or their 10% test. I think there's a little bit of concern that those deadlines might need to be extended. Any update on what Congress or the IRS is thinking about with regard to that?
We know they know about it. They've heard from us. We've had discussions with the service as an affordable housing industry, direct conversations. So they're very aware of the need to change some of these deadlines. We've also had discussions with Chairman Neal, the Ways and Means Committee. He has written a letter on our behalf, along with Representative Delbaney from Washington State, to Secretary Mnuchin asking for regulatory relief. We haven't seen anything yet, but they spent a lot of money, and we keep waiting as agencies are trying to fill in the rules behind the policy. It's the same for us in this regulatory setting. There's a bit of a Wild West going on, but we will push through, and I believe that we will get those deadlines extended.
Great. I want to ask about the Community Reinvestment Act, which came up before in the context of the fact that that CRA drives a lot of investors into this particular kind of investment. Could you explain what's going on in terms of proposed reforms to CRA, why people should be interested in that, and at least your take on whether there's going to be significant CRA reforms this year?
The comment deadline, which was originally in early March, was extended to, actually it was early February, was extended to April 9th. So the comment period is over. The OCC will have to review all of the comments and all the letters and respond to all of those letters. And my understanding is that they received over 11,000 letters. So they have to respond to every one of those before the act. There's a lot of concern about CRA reform and the way they've proposed it, primarily because they're proposing that there is no longer a separate investment test for banks. There's a number of other provisions, but that seems to be the big one that would add uncertainty into the market. Under the current CRA scoring, 25% of CRA scores derive from bank investments. And so this provided a very strong incentive for banks to invest in the housing credit and has contributed to the role that financial institutions, as you heard from our wonderful syndication representatives, played in roughly 3/4 of all the housing credit investment in the United States. We'd like to limit the activities eligible for community development credit. They've expanded them greatly. As an example, you could get CRA credit for repaving a road. Well, that's not going to help anybody in housing. So we'd like to limit the activities that are eligible for CRA credit. We would like to reduce the basket of qualifying activities that fit within the community development test. And we want to make sure the low-income housing tax credit is one of those qualifying entities. There also, Greg, is some move in talking to folks both at Treasury and the White House about putting this whole thing on hold for now. But the uncertainty isn't something that we really need right now. And I think there's a good chance that something like that will happen in the coming weeks with an announcement from Treasury down to the OCC. Joseph Otting, who's the director of the OCC, would have to make that announcement. So we shall see.
Okay, so it sounds like if the version of CRA reform that is on the table right now, if there's some concern that that's not exactly going to be helpful in driving more folks into the LIHTC investor marketplace, then maybe if it does sort of freeze in place, that might not be a bad thing for us.
Yeah, yeah. Eliminate uncertainty wherever we can.
One quick clarification question from our friend Amy in Cumberland. Would the January date for the 4% floor apply to projects which did not lock their rate at their allocation date?
Are they placed in service, Amy,
No.
in Cumberland?
They're not placed in service yet, but they had their opportunity and did not choose to lock. Would they still have the opportunity, if this passes, to use the higher rate?
I believe so, yes.
Okay, great. One other question, I guess, for you, Bob, maybe the biggest one here, is if there's a big train leaving in May, and that might be the last one leaving for quite some time.
Right.
What should folks do? I mean, we have 125 people who are listening right now in Maine and who are real concerned about the future of this program. Any thoughts, suggestions about who people should reach out to and when and what they should say?
Well, certainly our representatives are very sensitive to housing. I can't, when we had to do co-sponsorship for housing bills, the entire Maine delegation has been on board first every time. But I wouldn't take that for granted right now because things are moving very fast. What is happening in Washington right now is there is a tremendous amount of political maneuvering, groups, vested interest groups that are hiring lobbyists to further their goals. And especially in this the last train is what we're calling it right now. So we have to scream louder. We have to have the same message. You can't have different messages. It has to be one message. Let's get the 4% fix in the next package. Unfortunately, all four of our federal representatives are co-sponsors of the Affordable Housing Credit Improvement Act, of which the 4% fix was the primary goal. So I think they need to be reminded that we need the 4% fix. We need it in the next bill, and they need to hear from you. And you all know how to get a hold of them. So it really is important if you're out there and you're in development, or you're in accounting or syndication, or you're a developer, or you're a management company. They need to hear from you. And certainly it's important for all of us to have the same message.
Okay. All right. So it sounds like between getting the 4% floor and getting a rental assistance program, those are going to need to be two of our big key messages with our delegation in the coming days, next couple of weeks.
Yeah. And Greg, I would frame those two things as a 4% fix is needed now for the long term, and the rental assistance is needed for the short term, hopefully to get us through the next few months.
Okay. Bob, thank you very much. And obviously Bob as well is going to stay with us here because there might be more questions that people have.
Just one moment, just a clarifying question to follow up on our friend Amy's question. Nathan from Portland asks, what if the 4% deal did lock its rate last fall, but won't be placed in service until after January 2021?
I believe it would qualify for the 4% fix. If it's not placed in service as of January 20th, 2020, it qualifies for the 4% fix as the bill is written right now.
Thank you.
It's a big deal. Thank you very much, Bob.
You're welcome.
We're going to shift over to Mark Wiesendanger from Maine Housing. Mark, thank you for being with us. I think Mark's hanging out by the Golden Gate Bridge. Yeah. So Mark, can you just start us out talking about what things are looking like right now at Maine Housing, your schedule for upcoming rounds? Has any of that changed while all of this crisis has unfolded?
Quick answer is no, it really hasn't. You know, we've been looking at everything going on in the world and talking to all the folks on this call and all of our partners and trying to see what struggles people are dealing with. And I think that we've realized that the best thing we can do at Maine Housing is kind of maintain course and, you know, provide a sense of stability in this crazy world. Yet just yesterday we had a board meeting and we asked our board to commence rulemaking for the 9% QAT. And that was after, of course, a couple months of talking with MAHC and all of the people listening in on this call and hearing people's concerns and making some changes accordingly. And so that is moving forward at almost exactly the same schedule it was last year. We still intend to have pre-apps due in July, full applications due in September. And that may change next year. We had talked about accelerating the schedule a little bit, but we'll see how things play out, of course. So right now the 9% program is moving forward as planned. We also have an upcoming 4% round. It is, the draft is going around our building right now. People are chiming in and we're making sure that it's going to play well with some of the projects left over from the last 9% round, 4% rounds, help some of those projects along. And also that's going to play well with the upcoming state credit. We anticipate that the state credit is largely going to have similar timing to the 9% program and probably be very comparable in its funding. So we're looking forward to that. And we think that some of the projects that can't just take advantage of our walk-in 4% program right now will be able to come to fruition with combined 4% state credit when that comes about. Additionally, we are looking at Housing Trust Fund money. We are preparing another supportive housing offering right now that should be very comparable to the one last year, timing-wise as well. In most of our programs, I will say that we are, you know, we have increased our total development cost caps, both on per unit and per project basis. We have increased the amount of subsidy we're willing to put into projects. We are keenly aware that there are a lot of things that may cause delays in the near future with our projects, whether it's from a construction angle or a funding angle. We're well aware of that and we are looking at it. I think the way we are set up and how we always forward allocate, we have a pretty strong advantage. And honestly, looking at our portfolio just today, I think there's only one project we're really concerned about not hitting deadlines. And you know, to anybody who finds themselves in that situation, speaking to all the developers on the call, just give us a call. Let's talk about the best path forward. We might be able to find a solution fairly easily. And I think, you know, in some cases, we're probably going to be very lenient about certain deadlines that we have in place. but well, certainly in the case when it's something beyond the developer's control. But in the meantime, we just want to make sure that all of our partners are reaching out to us if they foresee any troubles, and we're certainly willing to work with them. But otherwise, we really just are trying to maintain course and put our program out on very much the same schedule as we have in recent years. And I think we're going to pull it off, and I think we are going to remain well funded, and that even considers that some of our funding may go to other uses, like the rent relief program that just came out recently. So that was some of our funding, and that's okay. We still have more. We're gonna make it happen.
Great. That's good to hear. A couple of questions have come in from people around the issue of rent revenue at low-income housing tax credit properties, and the question is, to what extent are you seeing decreases in revenue? To what degree are you analyzing trends there? And do you have concerns about any of that right now?
Of course, we have concerns about that right now. And largely, I should defer to my colleague, Bob Conroy, who runs our asset management department, for questions along those lines. But he actually issued a asset management program action steps notice on the 17th that people should probably check out, and talk to him about problems that they're seeing. Yeah, we definitely anticipate problems with rent revenues, and we will try our best to work around it as they arise. I think right now a lot of people are concerned that the rent relief program didn't address all issues, and that is just one tool of potentially many to help renters out there. So look to other things that we're doing, look to other things that might be coming down the pike. We're putting a lot of thought into a lot of things right now.
Okay, and any big picture sense on how much rent revenues have decreased in April so far by, small amount, a big amount, somewhere in between?
I couldn't speak to that right now.
Okay.
And we probably won't know until May how April turns out anyhow.
A question coming in is about the fact that many cities, many municipalities are sort of closed for business, and it's more difficult to get permits or to process TIFs because of that, maybe before the QAP deadlines. And the question is whether Maine Housing is taking that into account.
Yeah, certainly we're considering it. It kind of puts everybody in the same boat because every municipality is struggling with that right now. Of course, if we see some sort of really unfair advantage as we're getting closer to the application deadline, we may take some additional steps to ensure that there's some sort of fairness there.
Okay. Another question coming in is about stored materials and whether Maine Housing is considering changing policy to be more lenient in the payment of stored materials to avoid construction schedules.
We haven't talked about that recently. I'd be curious to hear your thoughts on it. I'm happy to have a discussion about it, and we're open to considering anything that would help folks as long as it makes sense within our programs. Okay. So feel free to reach out to me or Don McGilvery directly about that.
Okay. Before we kind of go to our free-for-all question and answer period for all of our panelists, anything else, Mark, that you want to share with folks about things that are going on at Maine Housing?
No, we are largely operating at full capacity right now. Everybody's teleworking and having lots of fun at it. We are, it is business as usual. We're just trying to keep things moving forward as best we can. We know that we're going to run into some hiccups over the next year or two, and that's fine. We'll deal with them as they arise. We just hope that our communication lines remain open and that people let us know when they're struggling. And together, I think we can find solutions to our problems. This call, being on this call is great for me as well. I'm really learning a lot about what's going on and from the syndicator standpoint, but also I think the information Bob's providing us is really interesting, and it'll help us from the advocacy standpoint.
Okay. Thanks again, Mark, for being on this call. I guess maybe we can bring all of the panelists back into view here. And I guess I'll just start by asking the question, is there anything you think that practitioners that are on the webinar right now should be thinking about, or that we should talk about that we haven't talked about yet?
One thing I would add, just in terms of COVID impacts on underwriting going forward, I think that we're seeing investors concerned about potential AMI decreases or AMI kind of stagnating going forward. And so, we wouldn't see that decline probably for a couple more years. So I know the 2020 AMIs just came out, and we would be looking forward to kind of 2022 to 2023 to see those impacts. But we may see some changes in terms of what our underwriting standards are for income growth going forward from what we use now, which is 2%. And same goes for vacancy rates. I think for deals without rental assistance, in certain markets, we've used 5%, but we typically use 7%, which includes 2% for bad debt. And I think that even for strong markets where occupancy isn't a concern, there may be a need to add, to increase that that assumption because of the bad debt concern. So just a couple things on the underwriting side that I think everyone should just start thinking about.
It's a great point.
Greg, I just like to say, I think people ought to keep an eye for opportunities in this during this period. I'd like to be positive about the outcomes. I mean, if you look at this screen, we're all sitting at home, so housing and homes suddenly resonates more than it's ever resonated before with people. And I think as a housing community, we ought to think about what things we're going to have to change or should consider changing. We're going to get a lot of kind of positive support for some telemedicine initiatives. I know that stalled in Maine for a while for a lot of reasons, but we should assume that that's going to come back, and we ought to be advocating for those kinds of things in our projects. And as developers, you ought to think about the way some of the kind of things that we are struggling with now and how we're going to fold them into deals going forward, whether it be, rent assumptions or operating expense assumptions. Food insecurities are paramount. Telemedicine and being able to do these things remotely are all going to find their way into our properties going forward. And I think we ought to just be open to those kinds of things and embrace them. So, this is as rough as this is. I think we ought to be looking for opportunities because we have a really good platform. The housing platform is it's got a lot of support right now, and I think we ought to take advantage of it.
Great. And Rob, a question I'll throw at you first that's come in here is, should developers wait to send out syndicator RFPs on their projects that they might want to be closing later this year or early in 2021?
Yeah, it's a good question, and one I answer about 15 times a day as people call and talk through strategy. And my answer is generally no. I think if you want to get closed this year, you really need to start putting a deal together. And if you don't send it out, I mean, you're not going to get closed. So you can send it out. We can see what we can do for you. If we can put something together, then great. If not, It's the same as waiting. So you might as well give it a shot. We're all happy to work hard on your behalf and try to put a deal together. If we can't, we can't. If the deal terms and the pricing isn't good enough, then we can hit pause and try again in a few months and see what happens. But the downside of sending it out now is we spin our wheels, but that's literally our jobs, is to try to figure out a deal for you. So I'd say send it out and give it your best shot.
Okay. Any, to Michelle or Bill, you guys feeling about the same on that?
Yeah.
Yes, it's good to know who's out there and what they're thinking, and that helps us go back to investors and give them a sense of what pipelines look like and what deals look like.
Yeah, I'd say we're still looking to build our pipeline and looking forward to the future when we can kind of get back to what we know is our normal. And like Rob said, there's no harm in looking at it now. Even if we can't move forward with a firm commitment, it's helpful to start thinking about placement options.
Great, thank you. You know, I think we're close to wrapping up here. Two quick things I wanted to mention is, again, this is our first webinar. And there may be other subjects that people feel like they could really use a similar webinar for. And I would encourage you to reach out to me or Liza with any thoughts about that, suggestions about that, because it seems like there's a little bit of a thirst for information, and this kind of setup seems to be pretty workable. So please get in touch with your thoughts about that. And secondly, in response to a question, this webinar is being recorded, and I will plan to circulate to everybody, I assume, a link. I'm not exactly sure how Zoom works with the recording, but I can only assume there's a link I can send around to folks so that they can access that recording. You know, I think I'm ready to kick it back to Liza here, unless anybody on our panel has any parting shots they'd like to throw out there.
Just thank you.
Thank you all so much. Thank you, panelists, for joining us today and for this conversation. And thank you to over 130 people who tuned in to this. And we will certainly keep in touch. As Greg said, we will follow up with the recording and be sharing that with our list. And please email us if you would like to see us do more of this, a continuation of this conversation at a later date, or another topic that you would like us to take up. And until then, stay safe and be well. And again, thanks for joining us today.
Thank you.
Bye, everyone.
Thanks,
Thanks for
everyone.
the conversation.
Be safe.